For investors who are looking for sky-high dividend distributions on a consistent basis, the covered call ETF is one of the best investment vehicles out there for several reasons. They all pay dividends on a monthly basis as opposed to quarterly, they're diversified in that they hold a basket of stocks in an index, and over time they have always paid a dividend amount between a specific range despite all the volatility going on in the stock market right now. And while these funds are great for income, they're not for everybody, since over the long term, these funds typically don't provide share price appreciation if that happens to be what you're looking for. However, reinvesting your dividends into buying more shares of your covered call ETFs will help create a snowball effect in terms of acquiring more and more shares. As I've discussed on this channel before, I believe covered call ETFs are a solid choice for people motivated by massive dividends or people who want to live off dividends with a lot less money than your typical S&P dividend stock. The company behind the most well-known covered call ETFs and who've made them as popular as they've become is Global X, which is a New York-based provider of exchange-traded funds with approximately $41 billion in assets under management. The company provides a whole bunch of other income-related ETFs, specifically for preferred stock, utility companies, and real estate investment trusts. But it's their covered call ETFs that are among their most popular, and in fact just recently they've been introducing more covered call funds. For example, they just introduced the Dow 30 Covered Call ETF, which is ticker symbol DJIA. It just launched 3 weeks ago, and it's still so new that as of the making of this video, they haven't paid any dividends yet, so the yield is still to be determined. However, today we're going to be examining Global X's three main funds that everybody's familiar with, which would be QYLD, or the Nasdaq 100 Covered Call ETF, RYLD, which is the Russell 2000 Covered Call ETF, as well as XYLD, which is known as the S&P 500 Covered Call ETF. We'll take a look at some of the more common metrics as well as the past performance of these funds and try to determine which one is best for holding in an income-producing brokerage portfolio. We'll start off by taking a look at the most popular covered call ETF, QYLD, which was launched all the way back in December of 2013. The fund seeks to generate income through covered call writing on the Nasdaq 100 index, which includes 100 of the largest domestic and international non-financial companies listed on the Nasdaq stock market based on market capitalization. If we look at a breakdown of what's inside this ETF, we can see that it has 103 different holdings as of March of 2020, and its top 10 holdings include a lot of tech stocks like Apple, Google, Microsoft, among others. When we look at the other funds on this list, you'll notice right away that QYLD is actually the least diversified, which is probably one of the biggest negatives about this fund. According to Yahoo Finance, QYLD currently offers an 11.8% dividend yield, which is the highest yield out of all the covered call ETFs. Over the past few years, this fund has typically paid anywhere from 15 cents per share to 25 cents per share. This ETF did pay a massive dividend in December of 2021 that was for roughly 50 cents, but that's not typical as you can tell by this graph. QYLD currently has over $6.3 billion invested in it, which makes it the largest covered call ETF, and it's also the most popular fund by Global X. XYLD, or the S&P 500 Covered Call ETF, generates income through covered call writing on the S&P 500 index. It seeks to track the performance of the SIBO S&P 500 Buy Right Index, and according to Global X's website, this fund was launched all the way back in June of 2013. I know in at least one previous video I mistakenly called QYLD as being the first covered call ETF, but it's actually XYLD, so I do apologize for that. But as of the making of this video, XYLD currently offers a 9.58% dividend yield according to Yahoo Finance, which isn't as great as QYLD, but it's still extremely high for a monthly dividend ETF and a solid choice. The dividend distributions for XYLD are pretty interesting. Starting in December of 2020, you can see the monthly dividend amount grew pretty significantly. And in fact, going back further before 2018, you can see the dividends were significantly smaller back then. But all that can be attributed to the performance of the stock market though, since volatility affects the dividend distribution amounts. Since September of 2020, this ETF has paid anywhere from 35 cents to about 45 cents per share per month. One thing I do like about XYLD over QYLD is the portfolio breakdown. Because XYLD covers the S&P 500, it has considerably more holdings in it. It also holds stocks in more industries, whereas QYLD is extremely tech-heavy. According to Global X's website, this fund holds 509 different holdings as of March of this year, which is considerably more than QYLD's 103. Anytime you have more diversification in your holdings means that you're going to have more downside protection when the stock market falls as a whole. The fund's top 10 holdings do consist of a lot of tech companies, but it also has companies like Johnson & Johnson, Berkshire Hathaway, and United Health Group, among others. Then finally we have RYLD, which is the Russell 2000 Covered Call ETF. This fund writes call options on the Russell 2000 index, and just like the other fund, provides distributions on a monthly basis using a covered call strategy. RYLD tracks the performance of the SIBO Russell 2000 Buy Right Index and was launched back in April of 2019, making this a much newer fund compared to QYLD and RYLD. Right now, Yahoo Finance gives this stock a dividend yield of 11.11%, which is phenomenal for income investors. While it is still a new fund, the dividend distributions for this ETF have been pretty consistent every month. It typically pays anywhere from 20 to 25 cents per share, and much like QYLD, RYLD paid a much larger dividend in the month of December, although not nearly as big as QYLD's. According to Global X's website, this ETF only holds one security, which is the Vanguard Russell 2000 ETF, ticker symbol VTWO. This fund is largely made up of stocks of small US companies and currently holds 2,073 securities, making it the most diversified covered call fund out of the three. The sector breakdown gives us much more details on how much diversification this fund offers. Tech companies only make up 12.2% of its portfolio. The two biggest sectors are healthcare and financials. But looking at just how many sectors are represented in this fund is a pretty pleasing thing in my opinion. During stock market sell-offs, funds like QYLD are going to have a much more extreme reaction because of less diversification. But tech stocks have also historically experienced significant amounts of growth when compared to other sectors. There are a few things that all three of these funds have in common. For starters, they all have the same expense ratio of 0.6%, which is an annual fee expressed as a percentage of your investment. It's basically how much money it costs to be invested in the ETF. 0.6% is a little higher than ideal in my opinion. These ETFs do all the covered call writing for you, which saves time and potentially any transaction fees, but when compared to your typical index fund, 0.6% is still slightly higher. I'm not really that concerned about it though. It is a lot cheaper than your average closed-end fund, and again, the massive dividends makes it worth the investment in my opinion. Looking at the total assets under management, we can see that QYLD is by far the largest covered call ETF in terms of total money invested. Roughly $6.3 billion have been invested in this fund, and to this day is Global X's most popular ETF. Coming in at second at all the way down at just $1.1 billion is XYLD, which again was the first covered call ETF by Global X, and then finally slightly below that is the Russell 2000 covered call ETF at just over $1 billion. So it's clear that QYLD continues to be the winner by a pretty big majority in this case. Finally, let's look at the past performance of these funds. It's important to keep in mind that the markets have been extremely volatile so far this year, given everything that's been going on in Ukraine. The Nasdaq in particular has been hit pretty hard, and while you can't perfectly predict everything, we can only hope that the market conditions will get better soon. I ran the numbers, and I'll go into more details in a bit, but if you would have invested $10,000 into any of these three funds at their inception date, you would not have lost money on your investment. So that's another important thing to keep in mind. But let's start with XYLD, the S&P 500 ETF that currently yields 9.58% according to Yahoo Finance, which is the lowest of the three. Since its inception, this fund's share price is actually up by a pretty considerable amount for this type of fund. First trading at around $40 per share in 2013, it's now at over $48 per share. Remember, these ETFs are all about huge dividends, so while an 8% per share gain doesn't sound like much, this doesn't take into account the massive dividends paid by this ETF. With RYLD, this fund is less than 3 years old, so there isn't that much of an extensive history behind it. It's gone through both the pandemic plunge and the volatility we've been experiencing right now. It's currently down over $1 from its original share price, but in November, right before all this turmoil, RYLD was trading above its original launch price. Finally, let's look at QYLD. This fund pays the highest dividends out of the three according to Yahoo Finance by quite a bit, but one of the biggest criticisms is that this fund is down from its original inception. On average, before the huge Nasdaq sell-off earlier this year, this fund was averaging a loss of roughly 2% per year of its share price. But again, the huge dividends this fund pays would have resulted in you not losing any of your investment, whether you chose to reinvest your dividends or not. Those dividends would have covered the losses in the share price. So after looking at all of this information, which fund or funds are the best here? I think in particular both RYLD and XYLD have a major advantage over QYLD, and that's the significantly better diversification that these funds provide. Like I mentioned earlier, during bad market conditions, these funds will suffer less than QYLD because QYLD holds more tech stocks, which can take quite a tumble during bear markets. XYLD also has a much better track record in terms of overall share price appreciation if QYLD is intimidating you for that reason. They're all huge dividend machines, but with taking everything into consideration, if receiving the highest dividends are your ultimate goal and you don't plan on selling your shares and plan to ride things out, or if you're going to be reinvesting your dividends for a while, then QYLD is probably going to be your best bet. If maybe you're motivated by huge dividends, but you're still a distance away from retirement or you're intimidated by a declining share price, my recommendation would be to pursue RYLD or XYLD. Both of these funds have at points exceeded their original launch price, so if you ever do need to sell some shares, these two ETFs will put you in a much better position to do that. Some people also like to invest in all three of these funds for diversification, which is another option worth considering. But be sure to diversify your portfolio with other types of holdings like REITs and BDCs, and always perform your own research and due diligence before making an investment decision. Alright everyone, that's going to wrap up today's video. Thank you all so much for watching, I really do appreciate it. If this video benefited you in any sort of way, please click the like button below and click subscribe if you want to see more dividend investing strategy videos. It would just let me know that there's a sizable enough audience out there who wants this kind of content, and I'll continue to provide you all with that content. Alright everyone, thanks again for watching, and I'll catch you next time. Take care.